Let's start by reviewing some common terms used regularly in insurance. The insured is the person covered by an insurance policy. A policy is a contract between an owner and an insurer that provides coverage in the event of specific happenings stated in the contract. The insurer, also called the principal, is the company issuing the policy. The owner is the person who has all rights contained in the policy and is often the same person as the insured because most people purchase their own policy. The death benefit, also known as coverage, face amount, face value, or policy proceeds, is the amount of money received once a claim or demand for payment is filed. A producer is an insurance agent or broker who sells insurance, delivers policies, or collects premium. Some texts and exams refer to a producer as an agent. A producer license permits an agent to conduct business in a particular state. It can be issued once the agent passes the state exam and applies to the state for their license. In some states, it's called an agent's license. The license can be resident or non-resident. An appointment is the authorization that an agent or producer receives to represent an insurance company. The law of agency says that the producer's actions within the scope of the authority become the actions of the insurance company. The three types of agent authorities are express, implied, and apparent. Express authority is granted by means of the licensee's contract with the principal, which is called the agency agreement. Implied authority is not expressly granted, but the agent is assumed to have it in order to transact day-to-day insurance business. The last type of authority is apparent authority. It is the appearance of authority based on certain actions of the producer. The commissioner or superintendent enforces the laws of the legislature, oversees the insurance industry, and has a wide range of powers and duties so that he or she can effectively administer the law.
Now that you have an understanding of some of the terms associated with insurance, let's examine some general insurance terms. Risk is a chance that something will happen. Loss is a financial hurt. It is the basis for a claim under an insurance policy. There are two classes of risks. The first is called speculative risk, which involves the chance of both gain and loss. An example of speculative risk is betting at the racetrack. Pure risk is the type of risk covered by insurance and only involves the chance of loss. There is no possibility of profit with pure risk. We are exposed to risk through perils. Perils are the cause of loss. A hazard is anything that increases the likelihood that a peril will occur. Ways to handle risk can be remembered by using the acronym STAR. S-T-A-R-R means share, transfer, avoid, reduce, and retain. Of the five, transfer is the most effective way to handle risk. The most common method of transferring risk is through insurance. Insurance is based on the principle of indemnity. This means that it is designed to return a person to the financial position they were in prior to the loss. The law of large numbers is an important principle of insurance, which says the larger the number of individuals involved in a group, the more accurate the prediction of loss will be. So, a group of 10 million people would provide a more accurate prediction of risk than a group of 100.
The best way to learn about insurance is to follow the process of purchasing a policy. A policy is a contract between a policy owner and an insurer to provide a benefit in the event of a loss. Just like the other contracts, an insurance contract has certain requirements that must be met. The basic elements of an insurance contract are summed up with the acronym CLOC, or CLOC, which stands for Consideration, Legal Purpose, Offer and Acceptance, and Competent Parties. Consideration is the value given by both parties. For the applicant, it is the completed application and initial premium. For the insurer, it is their promise to pay the policy benefit. Because the policy must be obtained for legal purposes, insurance contracts require that applicants have an insurable interest in the insured's life at the time of application. Insurable interest means the applicant must suffer a loss at the death, illness, or disability of the person being insured. Insurable interests also exist for close blood relatives and business partners. Offer and acceptance is collectively called an agreement. A completed application, along with the initial premium, constitutes the applicant's offer. The insurer accepts the offer if it issues the policy as applied for. Only competent parties may enter into an insurance contract. Incompetent parties or those lacking capacity include minors, individuals who are insane, or persons under the influence of drugs or alcohol. These types of individuals would not legally be able to enter into a contract. Individuals with language barriers may not be considered competent if contracts are written in a language they cannot understand. Although insurance policies are very similar to other contracts, they do have some special features that set them apart from other legally binding contracts. These special features are the doctrine of utmost good faith, which states that each party must rely on the integrity of the other. The doctrine of reasonable expectation states that the contract should do what the average person would reasonably expect it to do. Insurance contracts are also aleatory, which means there is an element of chance that the dollar values exchanged between the two parties may not be equal. An applicant could pay a relatively small amount into a policy and still collect a large death benefit. Adhesion means that one party, typically the insurer, has prepared the contract and has issued it on a take-it-or-leave-it basis. Because of this, any ambiguities in the contract will always be decided in favor of the insured. Remember that adhesion means to stick. In a unilateral contract, only one party makes a legally enforceable promise. The insurer promises to pay the policy benefits if certain conditions are met. An insurance contract is also conditional, meaning certain conditions must be met before the claim is paid. Finally, an insurance contract is personal because we would only insure those things that are economically significant to us. A warranty is a statement made by an applicant that is guaranteed to be true. A representation, on the other hand, is a statement made by an applicant that is believed to be true. All statements made by the proposed insured in the application are representations, not warranties. Concealment occurs when the applicant only reveals some of the relevant information. A waiver is the voluntary giving up of rights. Once an applicant has waived his or her rights, he or she cannot get them back. Estoppel is the legal extension of a waiver. The courts can stop someone from asserting a right based on the fact that they waived that right in the past.
The first type of company a person could purchase a policy from is a stock insurance company. These companies are owned by their stockholders, and their primary purpose is to make a profit. When a stock company declares a dividend, or return of profit, it is payable to the stockholders. This type of stock dividend is taxable. The second type of company is a mutual insurer, which does not have stockholders but is owned instead by policy owners. When a person buys a policy from a mutual company, that policy owner becomes both a customer and an owner. Dividends that are declared through mutual insurers' participating policies are payable to the policy owners. These are called policy dividends and are not taxable because they are considered a return of part of the premium paid. Any reference to a dividend on a state insurance exam is referring to a policy dividend. A mutual company can issue either participating policies, which are also called par policies, or non-participating policies, which are also called non-par policies. Par policies have higher premiums than non-par policies. Remember that only par policies pay policy dividends to policyholders, and they are not taxable. The third type of company, fraternals, are like a club. They provide life and health insurance to members. Reinsurance is when one insurance company is seeking to share or transfer part of its risk with another insurance company. A company is designated as admitted or approved when it meets certain minimum qualifications, including financial strength, and is granted permission to conduct business. The company then receives a certificate of authority. A non-admitted or unauthorized company is an insurance company that has been denied permission to do business in a specific state. Insurance companies sell their products in a variety of ways. Under the general agency system, agents are recruited, trained, and supervised by a general agent who has a vested right in their business. Under the independent agency system, licensees do not work for any specific company but have agency agreements with multiple insurance companies. The most common type of agent is the exclusive or captive agent who works for only one specific company. Finally, direct response marketing systems are those companies who rely heavily on TV and/or mailing advertisements. No matter what type of agency system is used, the company is ultimately responsible for the content of any and all advertising that bears its name. Defamation means to circulate any statement that is maliciously critical of any person or company engaged in the insurance business with the intent to harm. Illustrations are considered to be advertising because they are for the public. The Insurance Guarantee Association is funded by insurers and was designed to protect policyholders from financially troubled companies. In the event that a company becomes insolvent, the association will step in and pay benefits up to certain limits. Advertising laws prevent licensees from falsely implying that the government is ensuring the financial stability of the insurance industry through the Insurance Guarantee Association. The Insurance Guarantee Association is made up of admitted insurance companies.
There are several key reasons for purchasing life insurance. The first reason is for survivor protection, which protects the financial well-being of the insured's family in the event of the insured's death. The second reason is estate creation, in which an estate is created from the benefits of the life insurance. The third reason to buy life insurance is estate preservation, or maintaining the estate that the insured has already created using life insurance proceeds, which are more liquid than some other assets. There are two basic approaches to determining the proper amount of life insurance that should be purchased. One method is known as the human life value approach. This approach says human life can be stated as a dollar value by determining the economic value of a person's life. The needs approach is the most popular method used today. Instead of using a formula to determine the future economic value of the insured, all expenses required to cover an insured's family future needs are added up. This includes burial expenses, mortgage payments, emergency funds, college funds, and outside sources of income, like investments and Social Security.
The processes of selecting and classifying risks are called underwriting and field underwriting. The application is the primary source of information used in the underwriting process by the insurer. It contains both non-medical information like an applicant's name, address, and job description, called Part 1, and medical information like health history, Part 2. Part 3 of the application contains the agent's report, disclosure statements, and required receipts. Because the application forms a part of the policy, both the client and the agent must initial any changes in the application. A conditional receipt is designed to provide temporary coverage during the underwriting process. With a conditional receipt, the company agrees to start coverage on either the application date or the date of the medical exam, provided the insured is insurable, as applied for in the application. The first premium must accompany the application. The Medical Information Bureau, MIB, is a nonprofit central information agency established by member insurance companies. Its purpose is to provide a reliable source of medical information. The MIB helps hold down the cost of insurance by preventing misrepresentation and fraud. An attending physician statement, APS, is a report from a doctor detailing diagnosis, treatments, and prognosis. A medical examination can require anything from a blood and urine lab testing to a complete checkup. The type of medical exam the insurer requires is usually based on the amount of coverage applied for and the age of the applicant. The HIV consent form is required because many insurers are requesting HIV testing on their applicants. Insurers are required to disclose this information to the client at the time of application through an HIV consent form. The Fair Credit Reporting Act is a federal law which requires that an applicant be notified if the insurer plans to obtain an investigative consumer report. Written disclosure must be provided to the client at the time of application. The client has the right to question the validity of any information contained in the report. The insurers must identify the source of the information. The Privacy Protection Act limits the use and disclosure of insurance information. Classification of risk. Once a decision has been made to issue a policy, the company determines how much of a risk an applicant is to them. There are 3 classifications of risk. Standard risk is the average health on which premium rates are based. Preferred risk is above average health, and substandard risk is below average health. Adverse selection is the tendency for poor or substandard risk applicants to apply for insurance more than those with standard risks. The statement of good health indicates from the client that he or she is substantially in the same physical condition as they were at the time of application. The premium is the amount the insurer will charge for a policy. It breaks down into 3 categories known as MIE, mortality or morbidity, interest, and expense. Mortality in life insurance is the statistical estimate of the rate of death, and morbidity in health insurance is the rate of disease or the probability of illness or accident. Interest is earned when the insurance company invests premiums. The interest earned helps reduce the overall cost of an insured's premium. Expense is the operating costs of the insurance company, which is passed on to the clients. Gross premium is a calculation of premiums which includes risk, interest, and expense. Net premium is premium without the expense component. Cost comparison is comparing insurance policies to determine which one would be best for an applicant. Interest-adjusted methods have two types of cost comparison. Cost index, which compares the cost of the policy if it were surrendered after a specific period of time, like 20 years, and net payment cost index, which looks at the cost of the protection over an extended period of time. The last method is a comparative interest rate method and compares the interest rate based on premiums paid versus cash value buildup.
Keep in mind throughout this section that a lump sum death benefit is paid to a named beneficiary income tax-free. Term insurance, also called temporary life, offers coverage for a specified time. It pays a stated face amount if death occurs within the time period or term. Different types of term insurance include A. Level term where premium and face amount remain level for a specified period. B. Decreasing term, where the premium remains the same but the face amount decreases each year. This type is commonly used for mortgages. C. Increasing term, where the face amount goes up each year. This policy is primarily used as a rider to add a feature to a specific policy. D. Annual renewable term, also known as ART. This type of policy renews yearly. The face amount remains the same, but the premiums increase each year as the insured gets older and are more likely to die. Most term plans provide two options, to renew or convert. 1. A renewable plan allows policyholders to renew the term plan before it expires without having to prove insurability. 2. Convertible allows a policy owner to convert the term plan to a whole life or permanent plan. No proof of insurability is required. Whole life, also known as permanent insurance, provides death or living benefits. A whole life policy remains in force to age 100. Builds cash value or equity. Has cash value that grows on a tax-deferred basis. The cash values belong to the policy owner if the policy is canceled. While the policy is in force, the owner can take a policy loan against the cash values but will be charged interest on the loan. If not repaid, the loan amount plus interest will be deducted from the death benefit. At age 100, the policy matures or endows. Taxes would be due for any amount received in excess of what the insured contributed in premiums. Remember, a whole life contract is an either-or proposition, either the death benefit or the cash value. There are 7 types of whole life policies. The first type, straight whole life, which is what was just covered where premiums and coverage continues to age 100. The second is limited pay whole life. Here, payments are limited to a certain amount of time or to a certain age. For example, you could purchase a 20-year limited pay policy, known as a 20 pay life, that would be completely paid up after 20 years, but coverage would continue until age 100. Life paid up at age 65 is another limited pay method where policy premiums are paid until age 65. The policy is then paid up, but coverage continues until age 100. Premiums for a limited pay policy are higher than a straight life policy because they are paid over a shorter period of time. In addition, the cash value grows at a quicker rate. The shortest payment period is a single premium, where the entire premium is paid up front in one lump sum. Think of this as buying a car for cash. Interest-sensitive whole life is a variation of a whole life policy and is sometimes called current assumption whole life. This policy is similar to the whole life contract we just discussed with 2 small differences. 1. Interest-sensitive whole life can earn a higher rate of interest on the cash value than traditional whole life. 2. The premium is set based on the insurer's assumptions. Those assumptions are periodically reviewed, and the policy's premium or coverage is adjusted depending on cost increase or decrease. Modified life sets premiums much lower than regular whole life for the first few years, then jumps to a higher level and remains there until age 100. Graded premium whole life premiums start even lower than a modified life policy. Increase each year for the first few years, then jump to a higher level premium until age 100. Remember, at the beginning, graded premium whole life has steps, while modified life is level. The adjustable policy divides itself into three components: type of protection, amount of protection, and premium. The policy owner picks any two, and the company then determines the third. Universal or UL policies combine an ART product to age 100 with the cash value that is invested at current interest rates. It is considered permanent protection because it lasts until age 100. Premiums combined with the investment returns pay first for the cost of doing business and the cost of the term policy. Any money left over becomes the cash value of the policy. Two advantages to the UL are: 1. The insured has the right to adjust his premium. 2. Partial surrenders are allowed with no interest charged, however the death benefit is reduced. Variable life policies consist of both a guaranteed minimum death benefit and a cash value invested in the stock market. The insured has no guarantees concerning the cash value because their investment could go up or down. Insurance companies must keep the monies for variable products in a separate account. Additionally, because the separate account is invested in stocks and bonds, the NASD and the State Insurance Department regulate all variable products, and an agent must hold a producer and a securities license to sell. Variable Universal Life, or VUL, is a hybrid policy that combines the protection element of universal life and term insurance with a cash value invested in the stock market like a variable policy. This policy gives the policy owner the right to a flexible premium and a partial surrender. A separate account is needed, and agents must hold both an insurance and a securities license to sell this product. A joint policy covers two or more people under one contract and is also known as a first-to-die policy. This policy pays when the first insured dies and then terminates. It is often used in business insurance. Joint and survivor policy, or last to die, pays only after the second insured dies and is frequently used in large estates for tax purposes. Family plan or family policy is the only one that covers all members of a family. The main insured is covered by a whole life policy, while the spouse and children are covered with convertible term. The spouse is covered by convertible term, so he or she can convert to permanent insurance if the main insured dies. Remember that convertible means a policy can be changed from term to whole life. Family income. This plan uses decreasing term for its rider and only covers the main insured. An endowment policy is characterized by cash values that grow at a rapid rate. Think of an endowment as an abbreviated whole life policy for someone who wants all their money before age 100. If they died before the endowment date, the beneficiary would receive the face amount of the policy as a death benefit. The Tax Reform Act of 1984 took the tax advantage away from the endowment contract. As a result, many companies started marketing other products that would allow the policy owner to do basically the same thing. Congress passed TAMRA, which said any policy whose cash value grew at a rate faster than a 7-pay life policy would be considered a modified endowment contract. The policy owner would be subject to a 10% penalty and income taxes on any amount withdrawn before the age of 59 and a half.
Let's look at the standard provisions or clauses contained within the life insurance policy. Under the ownership provision, the owner has the right to name the beneficiary, receive dividends, if available, and access the cash value in either the form of a policy loan or partial surrender, depending on the contract. Generally speaking, the owner and the insured are the same person, and this is the presumption that should be made for testing. An assignment is an ownership change where the policy owner provides written notice to the insurance company to give the policy away. There are two types of assignments. 1. Absolute assignment is a transfer of complete control to another party. This assignment is often used when the insured is suffering from a terminal illness and needs money to pay for current medical expenses. 2. Collateral assignment is used to cover a debt. Proceeds paid under a collateral assignment will first reimburse the creditor up to the amount of debt, and then the balance of the proceeds is paid to the insured's beneficiary. The entire contract provision is found at the beginning of the policy and states the policy document, application, and any attached riders make up the entire promise to pay. Any modifications to the contract can only be made by a company officer in writing and attached to the policy. The insuring clause is the basis for the policy. It sets forth the company's promise to pay. It appears on the cover of the policy, and it specifically indicates the names of the insured and beneficiaries, as well as how much the company will pay and when. Part of the insuring clause is the consideration clause, where the amount and frequency of premium payments is listed. The amount and frequency of premiums payments is also called the premium mode. The free look provision allows policy owners the right to return their policy and receive a full refund within a specific period of time from policy delivery, usually 10 days. The payment of premiums clause says that all premiums are payable to the company in advance. The grace period allows an extra 30 or 31 days beyond the premium due date during which a policy is kept in force. If the premiums are not paid by the end of the grace period, then the policy will lapse or cancel. The reinstatement provision allows the owner to reinstate a lapsed policy by paying all back premiums with interest, any outstanding loans, and reproving insurability. Usually, the time limit that an owner has to reinstate a policy is limited to 3 years. The incontestability clause states that after the policy has been in effect for 2 years, the insurer cannot refuse payment of the proceeds, even on the basis of fraud, thereby limiting the amount of time the insurer has to contest the policy. The misstatement of age or gender provision allows the company to adjust the death benefit at any time if it is discovered an insured was paying the wrong rate based on age or sex. The company will adjust the benefits up or down to reflect the proper benefits. Remember, the company has the right to adjust at any time, so the provision extends beyond the 2-year incontestable clause. Exclusions are insurance riders contained in the policy that will cause the policy not to pay a death benefit for specific reasons. The suicide clause is the most common exclusion. This clause protects the insurer from having to pay if the insured commits suicide within 2 years from the policy issue date. If suicide is committed within the 2 years' time, the company will return all premiums paid. However, the company must pay the full death benefit if suicide is committed after 2 years. Other exclusions or restrictions are aviation, including pilots, student pilots, and stunt pilots, hazardous hobbies, and occupations. These may be underwritten differently than the average insured. The insurer may decline or rate the policy depending on the answers in the aviation questionnaire, or they may exclude deaths resulting from such activities.
A rider is a supplemental agreement that expands or reduces coverage. The term rider is probably the most common in insurance. It is used to add additional coverage or another person to the policy, such as a spouse or a child. The accidental death and dismemberment rider, also called double indemnity, provides for an additional amount of insurance equal to the face amount if the insured dies as a result of an accident, usually within 90 days. Since it covers 2 different losses, the policy will define the amount payable for the death as the principal sum, which is equal to the face amount of the policy, and the amount payable for dismemberment as the capital sum, which is usually equal to 1/2 of the principal sum. The guaranteed insurability rider is used to purchase additional amounts of insurance in the future without evidence of insurability. Usually, the rider would limit when this additional insurance could be purchased to specific intervals or when specific life events occur. A cost of living rider allows the policy owner to add a specific amount of insurance to the policy each year to keep pace with inflation. The return of premium rider provides that if the insured dies within a specified time, the policy will pay the face amount and return all premiums paid. The waiver of premium rider provides that if the insured becomes totally and permanently disabled for at least 6 months, called the waiting period, the company will waive the premiums as long as the disability continues. Once the disability ends, the insured will resume normal premium payments. The 6 months' premiums are usually refunded after the claim is processed. In a juvenile insurance policy, the payer benefit rider waives the premiums on the minor's coverage if the policy owner dies. Premium payments resume when the insured reaches a predetermined age. The waiver of cost insurance rider is similar to the waiver of premium and is used in the universal life policy. Here, the company would only pay the minimum premium and no additional cash buildup would occur in the universal life policy. Automatic Premium Loan Rider, or APL, does not cost any additional premium. This rider gives the insurance company permission to take a policy loan against the cash value if the policy is in danger of lapsing.
The primary beneficiary is the first in line to receive benefits. The contingent or secondary beneficiary is second in line to receive benefits if the primary beneficiary is no longer living. Tertiary beneficiary is third in line and will only receive benefits if the person above them has predeceased the insured. An irrevocable beneficiary can be designated when the owner wants to ensure the beneficiary cannot be changed in the future. However, this designation severely limits the rights of the policy owner because changes can only be made to the policy with the irrevocable beneficiary's consent. The Simultaneous Death Act states that the insured died last if both the primary beneficiary and the insured are killed in the same accident, and there is no proof of who died first. The Common Disaster provision specifies how the proceeds will be paid if the insured and primary are involved in a common accident and die. This provision states that the insured outlived the beneficiary, provided that death occurred within a specified period of time following the accident. The Spendthrift Clause protects proceeds left with the insurance company from the beneficiary's creditors. Choices on how to pay out death benefits are known as settlement options. Although the policy owner has the right to choose the settlement option, if the owner fails to do so, the beneficiary may select one at the time of the claim. The first settlement option, lump sum, is receiving the total face amount at one time. The second option is a fixed period. The policy owner or beneficiary picks a specific time frame for the proceeds to be distributed. The company pays the entire proceeds plus interest over that time frame. Fixed amount is the third option. An amount is specified for distribution at regular intervals until all proceeds and interest are exhausted. The fourth option is interest only. The insurance company holds the benefit, which gains interest until the beneficiary decides what to do with the proceeds. The last option is an annuity, which will be discussed later. The law requires that insurers act fairly in the settlement process. Any unfair settlement practices could cause the company fines and penalties. An example is if the insurer attempted to coerce a beneficiary into taking less money than he or she is legally entitled to.
Non-forfeiture values are benefits in a life insurance policy, which are available by law to the policy owner and cannot be forfeited. If a policy is canceled, there are three non-forfeiture options. 1. Cash. 2. Reduced paid-up insurance, which is buying a single premium whole life policy using current cash values as the premium. Or 3. Extended term, which allows the exchange of cash value for a term policy equal to the original face amount of the policy for a limited time. Earlier we mentioned that participating policies issue dividends, which are an overpayment of premiums and are not taxable. Dividends can be received through 5 options. 1. Cash. The company returns the dividend in the form of a check. 2. Reduce your premiums. The company reduces the next premium payment by the dividend amount. 3. Accumulate at interest. Dividends are left with the company and earn interest. When a claim is filed, the beneficiary receives the face amount of the policy, any accumulated dividends, plus interest. Although a lump sum death benefit is paid income tax-free, any interest received is taxable. 4. Paid-up additions allow the policy owner to purchase the same kind of insurance as the original policy, but the type of plan is a single premium paid-up insurance. 5. The one-year term insurance option is most often used when someone has an outstanding policy loan. It helps offset the loan amount if the insured dies.
In addition to the personal uses of life insurance, a business may also have a need to purchase life insurance. A buy-sell agreement is a legal contract between two partners to buy out the other's share of the business in the event of one partner's premature death. The joint life policy we have already discussed is a very popular choice for the buy-sell agreement. A cross-purchase agreement could be set up if there are 2 or more partners. Each partner buys a life insurance policy on each of the remaining partners. It works the same way as the buy-sell agreement, except there are more policies involved. For example, if there were 3 partners, 6 policies would be purchased. In an entity purchase plan, the business would own the policy. Key person life insurance can be used for any person in a business whose contributions are essential and whose death would cause a financial loss. The policy belongs to the company and is considered a company-owned asset. Split dollar plans are a type of employee benefit. These plans are informal and require no IRS approval. In a typical plan, an employer and employee share the premium cost of a life insurance plan. The employer contributes to the cash value and the employee pays the balance of the premium for the life insurance. Executive bonuses are another employee benefit available to select employees. The employee purchases a life insurance policy and names a beneficiary of his choice. The employer then gives the employee a cash bonus each year in an amount equal to the premium. The disadvantage of this plan is that the bonus is a taxable event for the employee each year. Group insurance is the final business use of insurance we will discuss. Group insurance covers a number of individuals under one master policy, is usually provided by an employer for employees as a benefit. The employees are not party to the contract. Provides that each employee receives a certificate of insurance. In a contributory plan, employees pay part of the premium, and the laws mandate that 75% of employees must participate. A non-contributory plan is one in which the employer pays all of the premiums and 100% of eligible employees must be covered. Eligible groups include single employer groups, multiple employer groups, also known as METs or multiple employer trusts, labor unions, trade associations, creditor-debtor groups, and fraternal organizations. A group of neighbors or a family would not qualify for group insurance. Group underwriting looks at the group as a whole. To be covered by a group plan, employees must be full-time, and there may be a 1 to 6 months probationary period. The probationary period is usually followed by an open enrollment period, typically 31 days. Should the employee fail to enroll during this time, proof of insurability may be required. Most group plans are usually ART, or annual renewable term plans. Therefore, when an individual leaves a group, they are automatically covered for 31 days even if they do not fill out conversion papers. The policy allows conversion to an individual policy when a member leaves the group.
The final element we look at regarding life insurance is the practice of replacement. Many states have specific guidelines to ensure that the client is made properly aware of what is happening with their coverage during a replacement situation. 1035 exchange is the IRS code that provides for the exchange of a life insurance policy, endowment, or annuity without a tax consequence as long as the exchange is on the same life. Replacements can be illegal if an agent persuades the owner to cancel, lapse, or switch policies and is not in the owner's best interest. The agent can be charged with churning if the replacement was completed entirely for the purposes of generating a commission. The two main types of retirement plans are qualified and non-qualified. Qualified plans were developed by the IRS to provide an incentive for people to save for retirement. The plan must meet the mandatory requirements and be filed with the IRS to get the special tax treatment. The monies invested may be tax-deductible, tax-deferred, or tax-free. Tax-deferred plans typically assess a penalty if money is withdrawn from the plan prior to retirement, which the IRS defines as age 59 and a half. Employee Retirement Income Security Act, or ERISA, regulates retirement plans to verify that they meet certain standards to be considered qualified. 1. The plan must not discriminate as to classes of employees. 2. Employees who are at least 21 years old and have completed 1 year of service must be allowed to enroll. And 3. All plans are also subject to vesting rules. Vesting refers to the right each employee has to the money in the account. An employee is 100% vested in their own contributions immediately. However, contributions made by the employer will vest according to a stated vesting schedule. Any plans not meeting the ERISA guidelines would be considered non-qualified. Anyone under age 70 and a half who has earned income may open an individual retirement account or IRA. All IRAs grow tax-deferred and some may also be tax-deductible. IRA guidelines require individuals to start taking money out of an IRA by age 70 and a half. Again, anyone taking withdrawals from an IRA prior to age 59 and a half must pay a tax penalty of 10% plus pay the income tax on the amount withdrawn. Rollover IRAs allow 60 days for a tax-free rollover if the money is reinvested in another qualified plan. An IRA transfer occurs when the money is sent directly from one fund custodian to another. A newer version of the IRA is a Roth IRA. One of the main differences between the traditional IRA and the Roth IRA is that the Roth grows tax-free if the account is at least 5 years old. Additionally, Roth allows for withdrawals for specific reasons without the 10% tax penalty, such as a first-time homeowner or a disabled taxpayer. Another difference is that the traditional IRA is tax-deductible, but the Roth IRA is not. Both the traditional IRA and the Roth have a 6% penalty if the contributed amount is more than the maximum allowed. The penalty is charged for as long as the money remains in the account. The next type of plans are usually available as a result of employment. The 401k is the most popular plan and is established by the employer. Employees may participate by electing to have money withheld from their paycheck. The employer can also match contributions up to a certain limit. The 403b, or TSA, tax-sheltered annuity, is a retirement program for employees of nonprofit organizations that was specifically designed for 503c corporations such as churches, hospitals, and schools. These employees are not eligible for 401ks. The Simplified Employee Pension, or SEP, is similar to an IRA. The major difference is that a much larger amount can be contributed into the SEP. Generally, an employer opens a SEP for its employees and will contribute to it on their behalf in years of profitability. The simple plan is designed for smaller businesses and works similarly to a 401k plan. Participating employees can defer some of their income, and the employer can match these contributions up to a specified amount. The KEO, or HR10 plan, is available for the self-employed. In the KEO, the employer would set aside money for himself and any eligible employees, up to a maximum. These monies grow on a tax-deferred basis.
Annuities are different from life insurance. Their primary purpose is to liquidate funds over a person's lifetime. Some characteristics of annuities are they can be purchased with a lump sum or installment payments. They earn interest. An annuitant may choose a lump sum or settlement option. In a settlement option, monies are withdrawn over a period of time. An important aspect of an annuity is that it allows the annuitant to choose a settlement option that will guarantee income for life. An annuitant is a person who receives the benefits from an annuity. The accumulation period is the period of time from the start of an annuity until payments begin. The annuity, or income period, is the period when the money is withdrawn from the annuity. Remember that an annuity is either in the accumulation period or in the annuity period. Annuities are classified based on the time when payments begin. An immediate annuity is purchased with a single premium and payout begins within 1 year of purchase. A deferred annuity can be purchased with either a lump sum or in installments, and payments begin after 12 months. The factors that determine the amount you will receive are age, the younger a person is, the longer they are expected to live, resulting in smaller monthly payments due to longer life expectancy. Gender. Since women live longer than men, men would receive a larger monthly income due to the shorter life expectancy if all else were equal. Size of account. The amount in the account has an impact on the amount of benefit. The greater the savings, the bigger the check. The expense or loading charge is the company's fee for handling the annuity. Although there are several settlement options to choose from, many of them mirror the settlement options for life insurance. The first one is one lump sum, where the person cashes in the annuity rather than annuitizing the contract. Keep in mind that taxes also apply. Next is a straight life option, which promises to pay income for life. If the annuitant dies earlier than expected, the company keeps any amount left in the annuity. However, if the annuitant lives longer than expected, even if funds are exhausted, income continues for life. This option provides the largest monthly income. Life with period certain is the next option. Think of this as life with a minimum guarantee. It guarantees payment for a specified time, 10, 15, 20 years, or life, whichever is greater. Under this option, if the annuitant dies before the specified time, payments will continue to his or her heir. Annuity certain is another choice, with a definite point when payments end. The annuitant can structure their annuity certain with either a fixed period of time or a fixed amount, depending on whether the need is to receive a set amount every month or to receive money for a specific period of time. Refund life is a new choice and the final option. The promise is still income for life, but if the annuitant dies before the entire principal is paid out, the beneficiary receives a lump sum cash refund equal to the balance. This sounds more appealing than straight life because of the promise to get a refund of all monies, but the monthly income will be less than a straight life option. The beneficiary can choose a lump sum or an installment option. Another factor affecting the payout is whether a fixed or variable annuity was purchased. A fixed annuity pays a stated interest rate, and the benefit received is stated in terms of dollars. For example, if an annuitant has a $10,000 annuity and is expected to live 10 years, under a life option, $1,000 would be received each year plus interest. However, with a variable annuity, just like with variable life, money is deposited into a separate account. The word variable indicates the money is automatically invested in stocks and bonds. There are no guaranteed returns with variable annuities. Payouts are determined by the success of the separate account, which is usually invested in common stocks. In order to keep track of investments in the separate account, the premiums an annuitant pays are credited as accumulation units. The value of the account will be the total number of accumulation units multiplied by their current value. On the day it is annuitized, the accumulation units are converted to annuity units. From that point on, the number of annuity units will remain the same. Variable annuities were developed to offset the effects of inflation. You must hold a life insurance and a securities license to sell variable annuities. Both the SEC and the State Insurance Department regulate variable annuities. If an annuitant does not want the guarantees of a fixed annuity or the volatility of a variable annuity, there are two other products to consider. In an equity indexed annuity, the account is tied to a specific index, such as the S&P 500. Its gains correspond to that index. There is also a market value adjusted annuity, where if interest rates on the account are equivalent to the stated rate, the monies can be withdrawn without issue. However, if the interest rate is higher than the guarantee rate and the annuitant wants to withdraw money prematurely, the company may assess a penalty. Alternatively, if the accounts were making less than anticipated, the company might try to encourage withdrawals. Although it is possible to purchase a non-qualified annuity, most annuities are sold as a qualified plan. As such, any attempt to withdraw money prior to age 59.5 is subject to both a 10% penalty and regular income taxes, since the account is growing on a tax-deferred basis. Any monies withdrawn after 59.5 are subject to income taxes only on the growth. The exception to this rule is if the annuitant's death occurs during the accumulation period. In that case, the monies are to be paid to the annuitant's estate and taxed accordingly.
Here are some health insurance terms and concepts to remember. Accident and sickness are the two major perils covered by health insurance. 90% of health insurance claims result from sickness rather than accidental injury. Service providers are Blue Cross and Blue Shield, health maintenance organizations or HMOs, and preferred provider organizations or PPOs. Two major categories of health policies are medical expense plans and disability plans. Premiums vary depending on the deductible, a yearly expense paid by insureds that may be expressed as an amount of time or an amount of money. The coinsurance percentage is when the insurer and insureds share covered loss, usually 80-20. The stop loss amount, when the company limits the maximum amount the insured pays out of pocket each year. The higher the stop loss, the lower the premium. After the stop loss amount is met, the company pays 100%. Or, premiums vary depending on the maximum amount of the benefit. Health policies exclude injuries caused as a result of war, intentionally self-inflicted injuries, injuries covered by workers' compensation, and cosmetic surgery, unless necessary due to an accident or birth defect. Pre-existing conditions are another type of exclusion found in health insurance. It is a medical condition which existed on the policy's effective date and for some period of time before. A probationary period is an amount of time when no coverage is available under the policy for the pre-existing condition.
All health insurance policies will define both the insurer's and the insured's right to cancel or renew coverage. Non-cancelable means that the insurer cannot cancel the policy or raise the premium. This usually only applies until the insured reaches age 65. For disability income insurance, the policy is renewed beyond age 65 only if the insured can provide evidence that he has continued to work full-time. The guaranteed renewable provision says the company must renew the policy but may increase the premium on the anniversary date on a class basis. In a conditionally renewable policy, the insurer may elect not to renew the policy under certain conditions which are stipulated in the contract. In addition, the policy premiums may be increased on the policy's anniversary date. An optionally renewable contract may be canceled for any reason at the option of the insurer. If the insurer elects to renew coverage, they can also increase the premium. A cancelable policy may be canceled at any time with proper notice. Any claim in progress must be honored. Time limit on certain defenses, which is similar to the incontestable provision, provides that after 2 years a statement or misstatement cannot be used to deny a claim except in the case of fraud. In the event of a pre-existing condition, coverage begins after the first 2 years. The grace period cannot be less than 10 days for monthly pay policies and 31 days for all other modes. The reinstatement provision stipulates that if the company accepts the premium after the policy has canceled without requiring a reinstatement application, they must reinstate the policy. However, if a reinstatement application is required, coverage is automatically reinstated if not refused within 45 days from the date the conditional receipt was issued. To protect against adverse selection, accidents are immediately covered, but sickness is covered after 10 days. The claimant must submit proof of loss within 90 days or as soon as reasonably possible, not to exceed 1 year. The company must pay any valid claim upon written proof of loss. Disability income benefits must not be paid less frequently than monthly. The insured must wait at least 60 days to file a legal action for grievance.
Medical expense plans could include a fee-for-service plan where providers receive a payment for their billed charges for each service provided. A prepaid plan where medical and hospital benefits are provided in the form of service rather than dollars. The provider is compensated regularly whether or not they provide service. The benefit schedule specifically states exactly what is covered in the plan and the cost. Usual, reasonable, and customary means the insurance company will pay an amount for a given procedure based upon the average charge for that procedure in that specific geographic area. The major medical plan is characterized by high maximum limits, blanket coverage, coinsurance, and a deductible. Generally, most major medical plans cover most medical expenses in and out of the hospital and have high maximum lifetime benefit limits. A comprehensive care medical expense plan incorporates a base plan and a major medical into a single policy. However, these policies contain a corridor deductible because the deductible actually becomes due after the base plan pays and before the major medical portion would take effect.
In the HMO Act of 1973, Congress strongly supported the growth of HMOs. Employers with more than 25 employees were forced to offer the HMO as an alternative to their regular health plans. The HMO provides service benefits rather than reimbursement. HMOs provide preventive care and encourage early treatment from physicians who meet their standards and are willing to provide care at a pre-negotiated price. A primary care physician or gatekeeper is regularly compensated by the HMO for the care of that member, even if the physician does not see the member. A copayment is a specific dollar amount or a percentage of the cost of care that must be paid by the member, generally for each visit. The HMO provides the member with inpatient hospital care in or out of the service area for at least 90 days per year. The Preferred Provider Organization, or PPO, is a group of physicians and hospitals that contract with employers, insurers, or third-party organizations to provide medical care services at a reduced fee. The subscribers are encouraged to use the PPO because a larger percentage of the cost is paid. Open panel is when the doctor contracts with the plan provider to provide medical services to their subscribers, but also retains the right to treat other patients. Closed panel is treating the members exclusively.
Disability insurance was designed to cover loss of income that occurs during a disability. A person becomes eligible for regular disability benefits when they meet the insurer's definition of disability due to either a sickness or an injury. In a disability income policy, the insured must be unable to perform work-related duties to obtain benefits. An own occupation, or own OCC policy, provides benefits when the insured, because of sickness or accident, is unable to perform his or her own occupation. An any occupation, or any OCC provision, only provides benefits when the insured is unable to perform any occupation for which he or she is suited by reason of education, training, or experience. Disability insurance can also be written on an occupation or non-occupational basis. Occupational coverage provides benefits for disabilities resulting from accidents or sickness that occur on or off the job, while non-occupational coverage only covers disabilities that occur off the job. Presumptive disability benefit provides a benefit for dismemberment. Generally, the policy pays for the loss of use of any two limbs, total and permanent blindness, or loss of speech or hearing. Some policies require actual severance of limbs rather than loss of use. Partial disability is often defined as the inability to perform one or more of the regular duties of one's own occupation. It is 50% of the total disability benefit and is usually payable for 3 or 6 months. Residual disability benefit is based on the insured's loss of earnings while disabled. Underwriting for disability income is unique due to the type of risk involved. The more hazardous the occupation, the higher the premium. As in life insurance, the underwriter can decline, rate up, or issue the contract with an exclusion rider. Most companies offer no more than 90% of the applicant's net earned income to provide an incentive for the insured to return to work. Disability income policies also exclude coverage for overseas residency or injury suffered while committing or attempting to commit a felony. The elimination period is the amount of time from the date of the disability until the policy begins to provide benefits. The longer the elimination period, the lower the premium. Disability income premium payments are non-deductible benefits and may be income tax-free depending on who paid the premiums. In order to avoid overinsurance, companies have several options that work with Social Security and workers' compensation benefits. Inflation and cost of living adjustment rider helps protect against inflation by increasing the insured's monthly benefit automatically on an annual basis once the claim has begun.
Group disability income insurance generally offers fewer limitations and exclusions and greater ease in acquiring coverage. They are generally less costly than individual plans and are offered as either short-term or long-term disability. In the group disability income insurance, premium payments are considered tax-deductible by the business as an ordinary business deduction, depending on whether the plan is contributory, non-contributory, or fully contributory. The employee receives fully contributory benefits tax-free. For partially contributory, the portion paid by the employee is received income tax-free, and the portion paid by the employer is included in the employee's gross income. For a non-contributory plan, benefits are also included in the employee's gross income. Benefits paid to an employee by an employer are subject to FICA withholding for Social Security purposes for a period of 6 months. To qualify for Social Security disability benefits, a worker must be either fully or currently insured. A fully insured worker must have worked 40 quarters. A currently insured worker must have worked 6 of the last 13 quarters and participated in Social Security. A worker must meet the Social Security definition of disability, which is the inability to engage in any substantially gainful activity due to medically determinable physical or mental impairment that has lasted or is expected to last 12 months. Or result in an early death. The waiting period is 5 months before disability benefits will begin. The benefit amount is based on the primary insurance amount, or PIA, which is calculated from the insured's average indexed monthly earnings over a set period of time.
The Business Overhead Expense Policy is designed for the small business owner. The policy will pay for actual business expenses such as rent, taxes, insurance premiums, utility bills, and employee compensation if the insured becomes disabled for a stated period of time. The insured's salary is not a covered expense. The elimination period on this policy is usually short, and the benefit period could be 1 or 2 years. The business disability buyout policy is very similar to the buy-sell agreement discussed earlier. The difference is that it is triggered by the disability of a partner. Benefits are paid in a lump sum following a specific period of disability, so the other partners may purchase the business. Workers' compensation is a hybrid policy required by the states that pays benefits for employees who are injured or killed on the job. Benefits vary from state to state. The 4 types of benefits are medical, small income, death, and rehabilitation.
Medicare is a federal health insurance program for aging, people with permanent kidney failure, and the disabled. Medicare has 2 distinct parts. Part A covers hospital expenses such as inpatient hospital care, inpatient care in a skilled nursing facility, home health care, and hospice care. It is funded through a payroll tax, and eligibility is automatic upon reaching age 65. Inpatient hospital care pays for up to 90 days in a participating hospital in any benefit period subject to a deductible. The first 60 days are covered at 100% of approved charges, and the next 30 covered days are paid after a daily copayment. Every Part A insured has a lifetime reserve of 60 days of hospital care. Home health care is available. Under certain conditions, Part A will pay for terminally ill insureds if the care is provided by a Medicare-certified hospice. Special benefit periods of 2 90-day periods and 1 30-day period apply to hospice care. Medicare Part B pays for a doctor's services and a variety of other medical services and supplies that are not covered in Part A. If the insured is eligible for Part A, he or she is automatically enrolled in Part B unless it is refused. If the insured declines enrollment, he or she must wait for the next open enrollment period to join. Part B has an annual deductible of $100 and an 80-20 benefit. Part B covers doctor services including surgical, diagnostic tests, x-rays, medical supplies furnished in a doctor's office, and office nurse care. Outpatient hospital services for diagnosis and treatment are also covered. Medicare Plus Choice is Medicare provided by an approved HMO or PPO. They may not charge additional premiums and no claims forms are required. Covers almost any medical problem for a set fee, so health cost can be budgeted. They may pay for services not usually covered by Medicare or supplemental policies. Medicare Supplement Policies, MSP, or Medigap, are policies issued by private insurance companies that are designed to fill in some of the gaps in Medicare. They pay some or all of Medicare's deductibles and copayments. Under federal law, insureds may not be denied during the open enrollment period, which is the first 6 months an insured enrolls in Part B. There are 10 standard Medicare supplement policies, which are identified with the letters A through J. Policy A provides the core benefits, and the benefits increase as you move through the plans. MSPs must be guaranteed renewable and may not duplicate benefits provided by Medicare. Limitations or pre-existing conditions must appear as a separate paragraph labeled as Pre-existing Condition Limitations. The probationary period for MSP is a maximum of 6 months. The definition of pre-existing condition in the policies must not be more restrictive than a physician's recommended advice or treatment given within 6 months before the effective date of coverage. The insurers must provide the Medicare Supplement Buyer's Guide and outline of coverage if a person is eligible for Medicare at the time of application. This Buyer's Guide must be provided even if the policies are not advertised, solicited, or issued as Medicare supplement policies. All MSPs have a 30-day free look period. Cost-sharing amounts under Medicare are changed automatically to coincide with any changes in the applicable Medicare deductible and copayment percentage factors. Cost comparisons must be fair and accurate and appropriate. No sale should give the insured more than one MSP. Notice regarding replacement. If replacement is involved, the insurance company or its agent must furnish the applicant with the notice before issuing or delivering the policy. The notice must inform the applicant of the 30-day free look period. The insurer must retain one copy, signed by the applicant and the agent. The replacing insurer must waive any time periods on pre-existing conditions, waiting periods, elimination periods, and probationary periods in the new Medigap policy to the extent that these time periods were met under the policy being replaced. The first page of the policy must contain a notice to buyer, which states that the policy may not cover all medical expenses. Twisting, high-pressure tactics, and misleading advertising may not be used. The terms Medicare Supplement, Medigap, Medicare Wraparound, and similar words may not be used unless the policy is in compliance with the law. Federal law requires that group health plans for 100 employees or more must provide primary coverage for disabled individuals under age 65 who are not retired and coverage for 18 months for individuals with end-stage renal disease before Medicare becomes primary. Medicaid is a federal and state-funded program for the poor that individual states design and administer under guidelines established by the federal government. To qualify for Medicaid, applicants must complete a lengthy questionnaire disclosing all assets and incomes. Once the financial requirements are met, a person must be over 65, blind, permanently and totally disabled, or caring for children receiving welfare benefits.
Long-term care insurance, or LTC, pays for the care needed by individuals with chronic illnesses or disabilities. It often covers the cost of nursing home and home-based care, like visiting nurses, chore services, and respite care for daily caregivers who need time away from these difficult duties. The difference between a long-term care plan and Medicare is that Medicare will not pay for long-term care required as a result of age. Eligibility for benefits is met when the insured is unable to perform some of their activities of daily living or ADLs, including mobility, bathing, dressing, toileting, continence, and eating. Long-term care normally provides coverage when the insured is confined in a state-licensed nursing facility that provides 24-hour nursing services under the supervision of a physician or nurse. Home health care is provided at home and may include visits by registered nurses, licensed practical nurses, licensed vocational nurses, or hospices. It might also include physical therapy and some custodial care. Adult daycare is provided for functionally impaired adults on less than a 24-hour basis and may be provided by a community center. Respite care provides a break for the caregiver. After an initial elimination period, the benefits period previously selected by the insured begins as long as the insured is in the nursing home. 2 to 5 years is the common benefit period. Daily benefits in the nursing home range from $50 to $200 per day. Several optional benefits are available with additional premiums, such as a guaranteed insurability option, which allows the increase of premium without proving insurability, and the return of premium rider, which is an optional non-forfeiture type benefit, which returns a percentage of the premiums paid. Long-term care premiums are tax-deductible if the total medical expense exceeds the limit set by the IRS of the taxpayer's adjusted gross income on the itemized deductions. However, the benefit is tax-free.
For a group policy, the contract is between the insurance company and the employer, union, trust, or other sponsoring group, just as in group life. 80% of all health insurance in force today is provided on a group basis. Group health insurance costs less than individual coverage because administrative costs and selling expenses are lower. Employer group health insurance requires eligibility as a full-time worker in a covered classification and must be actively at work. Dependents like spouses, children under 19, unmarried children between the ages of 19 and 23 who are full-time students, and unmarried disabled children over 19 who are incapable of self-support can be covered. A multiple employer trust, or MET, is made up of a number of individuals or small groups of individuals who ordinarily would not qualify for group insurance because of their size. These people can band together to purchase insurance at a better rate. A multiple employer welfare arrangement, or MEWA, is similar to an MET. It is groups of employers that pool their risks in order to self-insure. It can be any entity other than a duly admitted insurer. It establishes an employee benefit plan to offer or provide accident and sickness or death benefits to the employees of at least 2 employers, including self-employed individuals and their dependents. These multiple employer welfare arrangement groups can be sponsored by an insurance company, an independent administrator, or other group established to provide group benefits for participants. Creditor group, also called credit life and health insurance, is a specialized group insurance. It protects the lending institution from losing money as the result of a borrower's death or disability. Generally, the borrower is the premium payer and the lending institution is the beneficiary of the policy. Coordination of benefits is a provision that prevents duplication of benefit payments and overinsurance when an individual is covered under more than one group plan. This provision limits the total amount of claims paid from all insurers covering the patient to the total allowable medical expenses. It also establishes which plan is the primary plan and is responsible for providing the full benefit amounts as specified. For a married couple, primary coverage comes from the insurance provider where the patient is employed. If the patient is covered on the spouse's plan, it is secondary coverage. Children's coverage is generally primary, with the parent whose birthday comes first in the year. Once the primary plan has paid its benefit, a claim can be filed to the secondary provider for any additional benefits. Termination of benefits in a group policy is allowed in certain occurrences. For employees, coverage will terminate on the earliest date in which the employment terminates, employee ceases to be eligible, overall maximum benefit for major medical benefits is received, end of the last period the employee paid the required premium, or master contract is terminated. Terminated plans provide for an extension of benefits to any totally disabled employee or dependent, which is generally up to 12 months, or until the individual is no longer totally or continuously disabled. COBRA is the federal statute that guides the continuation of group coverage for terminated employees. The requirements are that an employer with 20 or more employees must extend group health coverage to terminated employees and their families for 18 months after termination of employment for reasons other than for misconduct, death, or divorce. For events such as death, divorce, or legal action, coverage extends up to 36 months for employee and dependents. the employer is permitted to collect a premium from the terminated employee at a rate no more than 102% of the individual's group premium rate. The terminated employee must exercise the extension of benefits under COBRA within 60 days of separation from employment. HIPAA legislation ensures portability of group insurance coverage and includes various required benefits that affect small employers, the self-employed, pregnant women, and the mentally ill. HIPAA applies to groups of 2 or more. Their employers must offer new employees who were previously covered by group health insurance at their old job for at least 18 months full health coverage immediately. If an individual with group health insurance leaves to become self-employed, he or she cannot be denied coverage. A coverage gap can last no more than 63 days. If the new employee meets the requirements, the new employer must offer coverage on a guaranteed issue basis.
Dental procedures require a separate policy because dental services are not usually covered by medical expense policies. Diagnostic and preventive care are routine preventive procedures, such as periodic teeth cleaning and fluoride treatments. Some of the policies require periodic examinations as a condition of coverage. Restorative care. Restorative care is treatment to restore functional use to natural teeth and includes treatments like fillings and crowns. The predetermination of benefits clause found in most dental plans operates just like the pre-certification already discussed. Dental plans attempt to minimize adverse selection by utilizing probationary periods because insureds who had no prior dental coverage are considered likely to have a large number of untreated dental problems. There may also be a limitation on benefits for late enrollees where benefits may be reduced for the first year. Even though COBRA regulates dental coverage, it is not convertible like individual health insurance.
To make sure that the insured is aware that the policy's benefits are limited, the insurance company must by law state plainly on the first page of the policy that it is a limited policy. Although AD&D benefits are commonly found as riders to individual and group life insurance contracts, they can be purchased as a limited policy. A hospital income policy provides a specific amount on a daily, weekly, or monthly basis while the insured is confined to a hospital. A credit disability policy is issued only to those in debt to a specific creditor. A blanket policy covers members of a particular group who are not individually named when they are participating in a specific activity. Such groups include students, campers, passengers on a common carrier, or sports teams. Thank you for joining us on this journey through the life and health insurance industry. You have now completed the audio lesson. We hope you've enjoyed this discussion. Should you have any questions regarding the material, please contact your instructor. Seize the Opportunity has been copyrighted in 2004 by Primerica.